Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In today's video, we're going to look at some bond alternatives. It's a request I've received from countless folks. As interest rates go up, the value of bond funds in particular get hit pretty hard. The question is, what should we do? Now, I'm a big believer in basically, doing nothing. I haven't changed my bond portfolio at all, but I know that a lot of you want to consider alternatives. So that's what we're going to cover. So here's what we're going to do in today's video. We're going to first look at a basic sort of standard bond mutual fund. So we kind of know what it looks like and what we're trying to achieve when we look at alternatives, okay? And then we're going to look at alternatives in three different categories. I'm actually going to give you some bond investments as alternatives to sort of your standard bond mutual fund. We're going to look at four of them. Then we're going to look at four actual alternatives to bonds that you might consider. And then finally, we're going to look at four things that a lot of folks say are good bond alternatives that frankly aren't bond alternatives at all. But it's important to understand why. Now, when I talk about bonds and a bond alternative, what are we looking for? And I think when it comes to bond investing, we're basically looking for three things. First, we want safety. We don't want to lose our money, right? Or at least we understand bond funds can go down from time to time. But we don't want to lose our money. That's why we tend to invest in U.S. government bonds or in investment-grade corporate bonds. For the most part, we stay away from high-yield junk bonds and emerging market debt. So we want safety. We want stability. If we want a lot of excitement, a lot of ups and downs, we'll just put our money in a stock index fund. But for bonds, we want some level of stability. And then, income, that would, interest, that would certainly be nice if we could get a little of that from time to time. So that's what we're looking for in a bond fund. And a great example of that, we'll take a look at it now, is Vanguard's Total Bond Market Fund. It's ticker BND. And you can see its 12-month yield over the last year, just under 2%. And I can make that maybe a little bit bigger for you. Its 30-day yield, meaning the yield based on the last 30 days, was about 2.5%. And the thing we want to focus on here as well is risk. And we're going to look at risk for a lot of these other investments. But we define risk based on standard deviation. And here for this fund, it's 4.17. The thing to know here is the higher the number, the more volatile the investment. So an S&P 500 index fund would be around 20, just to put it in comparison. And then finally, just so we understand, even a bond fund, as safe as it might be, loses money from time to time. This year, BND is down 5.85%. It was down 1.86% last year. Let's see, it was down a little in 2018 and again down in 2013. So bond funds do lose money. Even the best of the bond funds lose money from time to time. But so that's it. That's sort of our North Star. We want to try to find alternatives that maybe, might not lose quite as much money as, say, a standard bond fund. Okay, so as I said, I want to begin with giving you actually four bond investments that might be alternatives to this sort of traditional total U.S. bond fund. And the first is TIPS fund. And here's an example. Certainly Vanguard and Fidelity offer them. This happens to be an iShares TIPS fund. And we can see one important thing. You notice here the 12-month yield is just under 5%. And this SEC yield, which measures the yield over the last 30 days, 8.32%. You're thinking, what in the world is going on here? What a great investment. Well, the thing to keep in mind with a TIPS fund and its SEC yield is that in calculating that, it includes not only sort of the interest payments, but also any adjustments to the principal of the bond itself due to inflation. And that's why this yield can look so high. Don't, though, think for a minute you're actually getting 8.32% in interest. It's not how it works. However, I've included this in the list because, as you probably know, TIPS do better in a high inflation environment. So when inflation is higher than the market expected, TIPS do well. Now, that doesn't mean they don't lose money, right? If we go to performance, when interest rates rise, at least initially, TIPS will lose money as well. Now, in this case, this fund has lost 3% this year. That's not as bad as BND, but it can lose money. But again, if inflation is higher than the market expects, and certainly we're seeing high inflation today, TIPS can do very well. And I think they're an excellent investment to hold in addition to something like a BND. And in terms of risk, we always want to look at that standard deviation. It's very consistent with the BND fund or a total U.S. bond fund. Now, so that's the first bond that we can consider as an alternative to a total bond fund. The second one I bonds. I think these are probably today the best risk-adjusted investment you'll find. It's currently paying 7.12%. Now, unlike TIPS, unlike most bonds, I bonds are not publicly traded, which means, among other things, you can't buy an I bond ETF or an I bond mutual fund. You have to buy them directly from Treasury Direct, and there's a limit. It's $10,000 a year per Social Security number. You can actually get another $5,000 if you use your tax refund to buy them, but there's a limit to how much you can buy. And this interest rate changes every 6 months. Now, it will change again in a month or two here. And based on the CPI data that we have so far, it's going to be very consistent with the 7.12% you see here, maybe even higher, actually. So I think this is an excellent alternative. But again, there are limitations. In addition, you have to keep your money in there for a minimum of a year. If you take your money out of an I bond before year 5, you lose 3 months of interest. So make sure you understand those limitations. All right. The third bond as a bond alternative would be something like a Treasury bill fund. So a Treasury bill are U.S. government bonds that mature in under a year. The reason I mention this is if you're really scared about losing money and you just want to keep your money secure, this is one option. These are, backed by the U.S. government. They're as secure a bond as you can find anywhere. That's the good news. And in fact, if we look at risk, you'll see it's basically zero. The standard deviation is 0.28. I mean, it's about as riskless as you'll find. Now, that's the good news. The bad news is you're not going to earn much interest. And in fact, if we come here, you can see year to date, 2 basis points. Last year, it actually lost 10 basis points. So it can lose a little bit of money. But as you look at the history here of the performance, it's basically flat. But again, if your goal is to keep some of your money just absolutely safe, I think it is an alternative. All right, the fourth and final alternative in this first category are bullet shares, and this is an example of one of them. So bullet shares is just a name for a type of bond fund that Invesco has created, and they work very much like individual bonds in the sense that the fund will buy a bond and hold it to maturity. In this case, it's buying corporate bonds and holding them until 2024. So it's buying corporate bonds that mature in 2024. And unlike, say, a B&D, when 2024 comes around, at the end of that year, this fund will actually dissolve, and any money you have invested in this fund will be returned to you. So if you're wanting to effectively buy bonds and hold them to maturity, but you don't want to have the hassle of actually going out and buying individual bonds, you can buy Invesco bullet shares. They offer them with, you see, corporate bonds. They do offer high yield, and they also offer municipal bond bullet shares, and as well as emerging market debt. Now, those are things that personally I would not invest in, but I wanted to mention this. Now, the risk factor is very similar to B&D. Here it's 4.9. Performance while this fund exists, it can lose money. Now this year it's down 3%. That's less than B&D, although its duration is a lower as well. But it can lose money from one year to the next, so it's not a perfect alternative. But again, if you hold this to maturity, you will earn the yield to maturity on this fund. So those are sort of 4 bond type of investments that might be alternatives sort of to a traditional, total U.S. bond fund like B&D. All right, now let's move on to 4 alternatives that actually aren't bonds that you might, at least consider. And the first one is just the certificate of deposit, right? And they're FDIC insured, again, up to the FDIC insured limits. We're looking at a site called Deposit Accounts, which shows us some examples of some 5-year CDs. And you can see at the top here is just a little over 2%. So not a terrible yield in today's environment. You just have to keep in mind, if interest rates go up and you want to get out of most of these 5-year CDs, you will pay a penalty. It varies from bank to bank. And so you're going to want to make sure you understand those penalties. So that's at least an option. For those with a lot of money, you could consider what's called a brokered CD. I'm on the Fidelity website here. And brokered CDs are similar to bank CDs, but they're actually bought and sold in the open market, not unlike bonds. And sites like Fidelity can combine these so that you can actually put in far more than $250,000 and still have the FDIC insurance protection. And you can see some of the interest rates that you're seeing here. They're in line with what we looked at on depositaccounts.com. So again, with brokered CDs, it might be a consideration if you have a lot more than $250,000 that you want to put into a certificate of deposit, right? The third option, online savings accounts. We're back to deposit accounts just to look at some of the yields. I mean, are the yields great? No. You can see 77 basis points here is one of the highest that they list. But again, these are FDIC insured, again, up to the limits. And, it can be one place to park some money that, the value is not going to go down and you are going to get that yield. One advantage to online savings accounts as compared to certificates of deposit is that you can, take the money out anytime you want without penalty. Again, because of that, you tend to get lower yields, at least as compared to longer term certificates of deposit, which is just another way of saying there's no free lunch. You're getting something and giving up something no matter what we do here. All right. The fourth bond alternative that I want to mention is to repay debt, right? If you're paying certainly high interest debt, to me, getting out of that debt is probably the absolute best alternative. Now, I wouldn't go off and pay a low fixed rate mortgage as a bond alternative, but certainly if you have higher rate debt, certainly if you have high interest credit card debt, I think repaying debt can be, frankly, maybe the best investment you can make, and certainly I think a great alternative to bonds in today's market. So there are four sort of pure alternatives to bonds. Are they great? I mean, do they solve all our problems? No. I mean, we're still in a relatively low rate environment and interest rates are on the rise, it appears. And so, we will see savings rates and CD rates go up, and I've already seen that in some cases, but they're still pretty low by historic standards. All right, now, finally, I want to look at four bond alternatives that, frankly, I just don't think are bond alternatives. But if you go to Google and you say, hey, Google, what are some good bond alternatives? You will see these mentioned time and time again. So what are they? The first one, REITs, real estate investment trusts. I think folks mention that because their yields tend to be higher. This is Vanguard's REIT, and you can see it's 2.89% 12-month yield. So why is this not a bond alternative? Well, we just go to the risk factor here and we go to standard deviation. Look at that, it's 19. This is in line with an S&P 500. And we can see that when we look at performance, it's all over the place. This year it's lost 6% so far. Last year it was up 40. Year before that it was down over 4.5, up 28, down 6, right? I mean, it's up and down just like stocks. It doesn't make REITs a bad investment. I own this fund, as a matter of fact. And I think REITs can be a good part of a portfolio. They're just not bond alternatives. If you move part of your bond portfolio into REITs, effectively what you're doing is replacing bonds with equities. That's really what a REIT is. It's a form of an equity investment. Again, not a bad one. It's just not, in my view, a bond alternative. All right, number two, dividend-paying stocks. We'll see this a lot in articles online as a bond alternative, and it just ain't. Yes, they pay higher dividends than, say, an S&P 500 index fund, but again, we've got the risk factor. So here's a fund that I own, Schwab US Dividend Equity ETF. Again, it's not that this is a bad investment. It's just, look at the standard deviation. It's 18.21. Again, in line with the S&P 500, maybe a tad less volatile, but not by much, and certainly well above the 4 or 5 standard deviation we saw with a lot of the bond investments. And again, if we go to performance, with this particular fund, it's been quite strong over the last 10 years, largely because stocks have been quite strong over the last 10 years, but it still loses money from time to time, and it can lose a lot of money. So for example, if we were to repeat 2008, 2009, this fund would lose a lot of money. So again, I think it's a perfectly reasonable fund to include, but it's not really a bond alternative. All right, number three would be preferred shares. I include this in something that I don't really see as a bond alternative, but I suppose it maybe comes the closest that are in this list. I'm looking now just as an example at the Invesco Preferred ETF, ticker PGX. You can see the yields are quite nice, 5% over the last 12 months, and same with the last 30 days. Its risk is somewhere between bonds and stocks. You can see its standard deviation is around 10. So that's much less volatile than an S&P 500. That's the good news. At the same time, it's twice as volatile as a bond fund, and we have to keep that in mind. So is it a bond alternative? Not really, but kinda. How's that for an answer? Remember, preferred stocks sort of act like bonds and stocks. So there's a sort of a guaranteed, as much as any corporation will guarantee anything, interest payment. It's contractually promised, if you will. And so that's why it's kind of like a bond. But there's conversion rights where you can get converted to equity. So it kind of is a mix between stocks and bonds. But again, its volatility is twice that of bonds. So I don't really view this as a pure bond alternative. All right. And finally, and actually before we go to that one, let me just show you the performance on this one. And you can see it's down 8.5% this year. So yeah, there's volatility to this. And its returns, if you look at it, have not been nearly as strong as just a straight up S&P 500 fund. And so generally, I either want to invest in stocks or bonds. I'm just not a huge fan of getting into preferreds, although others would disagree with me, and that's fine. All right. The fourth and final alternative to bonds that I don't really view as an alternative, but you'll see this mentioned a lot of time, and that's annuities, and particularly the single premium immediate annuity, where you take a certain amount of money, you buy the annuity, and you immediately start getting, say, a monthly payment. In effect, not unlike Social Security, where you get this sort of guaranteed payment, although annuities aren't indexed to inflation. So there are no inflation adjustments today with annuities. Now, they do share some characteristics of bonds. That is to say, they're relatively safe. They're backed by insurance companies, but generally, if you find out a very highly rated insurance company, then the security is pretty strong, and you're getting this sort of consistent payment from month to month. So why don't I like it as a bond alternative? And it's because when you buy an annuity, the money's gone. It's no longer yours. You don't have control over it. If you pass away in a couple of years, the money's gone forever. You can't have your, say, children or someone else inherit the money. It's gone. And so in that sense, it's very unlike investing your own money, say, in a bond fund. Now, that doesn't mean annuities are bad. And I think single premium immediate annuities in particular can be a reasonable purchase as part of retirement planning in some circumstances. I just wouldn't look at them as a bond alternative. I certainly wouldn't invest in or buy an annuity today because interest rates were going up and bond funds were having a bad year. I don't think that is a good reason to buy an annuity, and so I would not include it in my own list as a bond alternative. Listen, I know I've gone through a lot here in a relatively short video. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.